This video is going to be about various policy effects on the value of that country's currency. So let's assume expansionary fiscal policy that causes deficit spending. What do you already know will happen because of this? So go ahead and pause the video now and try to come up with what happens with expansionary fiscal policy that causes deficit spending that will eventually affect the price of the US dollar, let's say. Alright, so with expansionary fiscal policy with a deficit, what we end up with is, because government is going to need to borrow money, it's going to increase the demand for loanable funds, driving real interest rates up or increasing. Now, that's going to increase demand for financial assets, thus increasing the demand for the currency. Because of the higher real interest rate, savers are going to be able to get more money for their savings or their financial assets, so they're going to demand more of that country's financial assets because of that, things like savings accounts and bonds and other things. The increased demand for currency leads to increased value of the currency and a higher exchange rate. Now, because of that, exports fall as they become more expensive. Okay, so let's say the US dollar has increased in value, so foreigners can now buy less of the American good, or the American dollar, thus less of the American goods, so our exports are going to fall. Now, imports are going to rise as the value of the US dollar is increased. We're now able to buy more foreign goods cheaper, as foreign goods are less expensive. Now, this is going to move us towards a current account deficit, which thus will mean a capital account surplus, as that is moved in the opposite direction. Now, if we look at contractionary monetary policy, if the central bank decides to contract the money supply, that's eventually going to cause real interest rates to fall, because as the nominal interest rates fall, ceteris paribus, real interest rates will fall as well. Now, that's because there's a decreased demand for financial assets from investors abroad, which decreases demand for the currency. So foreign investors are not going to want as many financial assets from this country like the United States in this instance, because they're going to get less interest on top of what they're going to invest in. So that's going to drive the exchange rate down graphically. And when the, for example, US dollar falls in value, that means foreigners are going to be able to buy more of the currency. And so exports are going to rise as foreigners buy more of our now relatively cheaper currency. And our imports will fall as foreign goods are now relatively more expensive, because our weaker currency now buys less of the foreign currency. Now, while those may have been a little abstract in terms of, well, what does that mean when the value goes up or it buys more? So let's say the US dollar is going to appreciate. So let's say one US dollar used to buy one Great British pound, and then that means that a 30-pound item is going to cost me $30 at that exchange rate. Now, if the dollar appreciates, let's say a dollar now buys 2 British pounds, and now that same 30-pound item is now only going to cost me $15 because of the exchange rate. So that's what we mean by the US dollar appreciating, is that it's going to buy more of the foreign currency, which means that the foreign products is going to become cheaper. Now, this is a drastic difference, and it would take many, many years or some catastrophic event in one of the countries to have the exchange rate double like that, where the US dollar becomes twice as strong against the British pound. But it just helps to illustrate that idea. Now, vice versa, if the US dollar were to depreciate, so it used to buy 1 pound, same 30-pound item, and now it only buys decimal 50, well, now that same item is going to cost us $60 to buy. So we're going to buy less of their goods. And if we're comparing it to, let's say, an American product in all of these situations that are $45, then we're really looking at, well, do we buy domestic, or are we going to go with the foreign competitors? So if the dollar appreciates, we're going to buy the now cheaper Great British good. And when the dollar depreciates, we're going to go and buy the American-made good, which means we're going to import less because we can't now afford that same item in Great Britain.